Hello everyone, welcome to this video. In this video, we will introduce some conceptions about inventory in accounting in 10 minutes. Are you ready? Before we introduce, we will see some professional English vocabularies. The first one is goods in transit, 在途存货. FOB is the free on board, 在船上交货. Then we will have 2 points, which is shipping points and destinations. Periodic inventory system is 定期 or 实地盘存制. Perpetual inventory system is 永续盘存制. Cost of goods available for sale is 可供销售成本. Inventory cost flow assumptions is 成本流动假设. Then we will have 4 assumptions, which are specific identification methods, 个别认定法. First in, first out. Nickname is FIFO, 先进先出. 2 average method, which is weighted average and moving average, 加权平均法以及移动平均法. So we will start from some ownership. Ownership is very important in inventories issues. Who own this inventory will be responsible for some maybe error or some transfer issues. So we will have buyer and seller. A sells some goods to buyer B. Then the goods from A will be called shipping point. Then from this rule, we will have a carrier to pass this inventory and want to deliver it to B. Then B will receive it in destination point. So if the A owns it in shipping point, means that the A will give the inventory to B from shipping point. Then B will be responsible since from the shipping point and the rule from this point to destination. On the other hand, if the ownership will transfer to destination point, which means that A, this is the seller, will be responsible from the shipping point and the rule before it's go to the destination. So we will see the title path in specific point is very important because when seller transfer goods to the buyers who will be responsible in the rule. So that will be the ownership. Then we will see important formulas about the inventory. Then we will see an important formula about inventory. So you can see this picture. Beginning inventory means that the opening balance at the beginning of the year, maybe the year or the month. And the purchase means that in this specific period, you purchase how much and how many inventories in your company. Then the end inventory is that maybe the final date of the year or the month, that way we calculate how many inventory in our stock. From this formula, you can get the cost of goods sold. So we will have the numbers and assumption. The $9,000 will plus the $7,700 in the purchase. Then we can minus the $9,200 in the ending inventory. Then get the $7,500 to our cost of goods sales. So from the first 2 parts, we will get the cost of goods available for sale, which means that you can have the beginning inventory and the purchase inventory as the total of available for sales in your company. So we will use this number to calculate about some formula. And we will have the 2 important inventory systems. The first one is periodic. Periodic means that you will need to physical count in a specific period, then determine the quantity of inventory. But you cannot track the cost of goods directly. Maybe you will need this formula to get the cost of goods sales. On the other hand, perpetuals means that you can know the quantity of inventories when you purchase and sell, but you need to update it for many times. You still need to physical count, but this behavior is needed to adapt to check and find the error, but it's not needed to determine the cost of inventory. you need use the physical count to find maybe some errors or some program that is not necessary in your company. So let's talk about the inventory cost flow assumption. What is cost flow assumptions? This means that the way we track the value of inventory. We would want to know how much the inventory that we cost in the process of the selling. So the first one, we get the specific identification methods, which means that cost of each item is uniquely identified and tracked. So this item will be very expensive and you can individually count it, such as the car or a diamond. That's very expensive, right? The second one is the first in, first out, which is the FIFO. The entire out inventory is the first thing that we saw. And inventory will approximately represent recent costs, which means that the first things that we buy from the others, then we will sell it firstly. So in our stock, we will have the last buy inventory to know that the any inventory will be more approximately represent what the price will be in the market, right? And we will have the two average ways. So the first one is weighted average method, but be careful, this method is for periodic system, not for the perpetual. Then they will have a formula to calculate per unit cost, which is the cost of goods available for sales. Are you still remember this one? And the units available for sales. So we will have the two parts to calculate it. Then this part will be suitable to homogeneous products such as the convenience stores, which have the drinking and the snack that is not different from the other ways. Then we will give an example of the weighted average cost methods. So we will have the beginning of the inventories in January 1st. Then we'll have the 300 units and 100 per unit dollars. Then we will have many information about purchase and sales. But the sales information will not be used in this example because we focus more on what time and how much we buy in an official year. So the $30,000 is the beginning, that is 300 units, and the 100 per unit cost. Then they will calculate as the 30,000. Then the 13,000 is the January 15, that is 100 units, and the 130 cost per unit to calculate and get it. Then we will plus each purchase in our formula, that is our total cost of available for sales. Then the 750 is the total units in this fiscal period. And we can see that the beginning is the 300 units. Then January 15 we'll get the 100 units and 200 units in February 9, 150 in March 3. So we will get the 750 in our available cost for unit. Then 137 plus 333, that is the weighted average cost per unit in our official year and this example. Final one is the moving average. This is for perpetual system, and you can see the formula is different from the weighted average, which means that you will want to focus the total units on hand and the cost of inventory order. So you need to recalculate after each purchase, which means that if you purchase 10 dates in your company in a year, then you need to recalculate it for 10 times. That is very complicated, right? But compared to what average variation is more current, because you will update the price in the market, so it will be more approximately close to the market values in your formula. From this table, we can see a lot of information. The first one is the beginning inventory, that is our opening balance, February 1st, and we will get the units and the cost per unit. Then we will give the moving average cost, but you will focus more on what? On the date we purchase. So February 2 that we purchase and recalculate moving average cost, then that will be 0.1480, and that is different from the beginning of the moving average cost because we recalculate when we buy the new cost, and we will plus the purchase of the units cost and the quantity of the inventory, then we will get the new one. But when you solve it, you will still need the moving average cost, but you will use the latest one, not the oldest one, right? So you will update it when you purchase the cost and you purchase the inventory. It will be more approximately close to the price in the market. So that is our today's video. Then we review the professional English vocabularies: cost in transit, FOB freight on board, shipping point and destination, periodic inventory system and perpetual inventory system, cost of goods available for sale, inventory cost flow assumption, specific identification method, first in first out, weighted average and moving average. Then this is our today's video. Thanks for your listening. Don't forget to subscribe our Facebook pages and give us a thumbs up if you like it. Thank you for your listening.